When it comes to stock investing, there are many different metrics that you can analyze in order to find good investment opportunities. One of the most important types of stock metrics is profitability metrics. Here, two key metrics that stand out are the ROA, the return on assets, and the ROIC, the return on invested capital. In this video, I'm going to share with you the difference between ROIC and ROA and how it is that you can calculate these metrics for many different companies and be able to compare them one by one. Okay, so the first step to really understanding the difference between the ROIC, the return on invested capital, and the ROA, the return on assets, is to be able to look at the first principles, which in this case is to look at the different formulas. So starting with the ROIC, we look at the formula, and the formula is the net operating profit after tax. This is the key term, after tax, divided by the total invested capital of the company. The return on assets, on the other hand, or the ROA, takes the net income and divides it by the average total assets. Now, in order to illustrate the difference between these two metrics right here, we're going to calculate them manually using the financial statement data for Apple so that you can see the difference in the numbers. And then what we're going to do is we're going to talk about the main difference in terms of what these different metrics take into consideration given their different formulas and calculations. To get the financial data, you can get it online by pulling up the company's financial report, or you can use an add-on like Y-Sheets, which automatically provides you with the data right on your spreadsheet, so that way you can do the calculations in one single place. So we're going to select Apple and we're going to get the annual data, although the quarterly data is also available. And here you can see that you're going to get the financial growth metrics, the key metrics of the company, the cash flow statement, the balance sheet, and the income statement. And all of this data goes back many years into the past. Now, with this data, now we can go ahead and calculate these two numbers. So we're going to enter the ROIC here and then the ROA here on this part of the spreadsheet. Starting with the ROIC, we need to get the different values that make up the formula itself. So as you can see, what we're going to do is we're going to start with the top of the formula, and this includes the net operating profit after tax. So we're going to calculate this value first. What you also have to know is that this is also known as a notepad, and don't worry, this is a relatively simple calculation. So I'm going to do it right here for you. What you need for this calculation is you need to take the operating income of the company, and then you're going to multiply by 1 times 1 minus the tax rate of that particular company. Now, how do you calculate the tax rate? Well, this is very simple. The way that you do it is that you basically take the income before you tax and you divide that number by the income tax expense. So we're going to take the income tax expense and then we're going to divide it by the income before the tax, which you can see right here. This is going to tell us to roughly what percent this company, in this case Apple, is getting taxed. And once you have that, make sure to have the proper bracket so that the calculation is done in the proper order. So we have the operating income times 1 minus the tax rate. That is going to give you the notepad. Okay, great. Now this is formatted as a percentage. Don't worry, you can just simply click on the formatting change to accounting, and now we can see this is the actual number for Apple. Now the next step is to do the bottom part of the calculation, which is the total invested capital. This is a little bit more tricky, but don't worry, I'm going to take you step by step through this calculation. Now for the total invested capital part, what I have done is I have left the formula that we're going to use in this case. Keep in mind the total invested capital can be calculated in many different ways depending on the data that you have available to you. However, for the data that we got using Y-Sheets, this is the calculation that I recommend that you use. So let's walk through this calculation step by step. So we're going to select equals and then total, and then we're going to enter the total assets of the company, which we can see right here. So here, total assets. And now the next step is to subtract the account payables of the company, which we can find right here. And then what we're going to do is we're going to take this minus the max And this max part is to make sure that you don't have negative numbers, which can happen depending on the values that you have inside of this. So we're going to take the total current assets. So in this case, we're going to get them right here. Now subtract the current liabilities. Okay, so this should be right here. Great. And now we're looking to add the cash and the cash equivalents. So this should be at the very top of the balance sheet. And then we're going to enter comma 0. So this ensures that if this calculation is negative, it's going to pick the 0. So that way it doesn't affect the calculation as a whole. And then after that, what we're going to do is we're going to go ahead and subtract the cash and the cash equivalents. So we're going to select this value again. Now the formula is finished. You can pause the video anytime if you want to copy the formula. And here Excel is just allowing us to make a correction just for the brackets themselves of the data. So we're going to click say yes. And this is the total invested capital that we're going to be using in the calculation. So something we can do is just go ahead, copy this value right here, and just make sure to copy paste it as values only. Now we're going to turn it into an actual number, expand the column, perfect. And now if we want to get the actual ratio, don't worry, we have all the information now available. We're going to take this minus this, and this is going to give us the return on invested capital for Apple in this case, based on the calculations that we did for the notepad, which that one pretty much remains the same no matter what. And then also the calculations that we made for the total invested capital part. Now the next step that we're going to do is we're going to compare this number with the return on assets number. For the return on assets, you can see the formula is right here. It's quite simple to follow, except what we're going to do is instead of the average total assets, we're going to take the total assets for the 22 number, so that way we get the actual number for this reporting period. We can do it all in one go because the calculation is quite simple. So we're going to take the net income and then we're going to divide it by, go into the balance sheet, and then select then the total assets of the company. Here we go. So now we can go ahead and compare the two numbers. I'm just going to move them right here so that way you can see them side to side. So as you can see in this case for Apple, the ROIC is way higher than the return on assets. And now we're going to talk about the key difference between these two numbers right here. After calculating the two numbers, what I want to emphasize for this video is that the difference between the ROIC and the ROA is straightforward. The difference is that ROA does not take into account the cost to be able to raise capital to fund the different investments that the company has made. So as you saw from the formula, all that we're taking into account is how much money the company made in net income, and then we're just dividing that number by the total assets of the company. So it's just taking those two variables. Whereas on the other hand, once we calculate the ROIC, you saw that the formula is a little bit more complex because it doesn't take the net income per se, it takes the operating income and it subtracts the tax. So it doesn't have all the components of the net income, which is a little bit more accurate from a cash flow basis because there's some expenses that you can see on the income statement that are reflected and taken into account for the net income, but they don't actually mean that the company has to pay that money in expenses. For example, depreciation and amortization is not something that the company had to use cash in order to pay for this particular expense, but it's more like the company has to save this amount of money to keep up with its depreciation and amortization of the assets that the company has. You saw that, so there's that difference on the top of the calculation, which is the net operating profit after tax. And then where it really shows the bigger difference is the total invested capital. For the total invested capital, we calculated this number right here. As you saw, the calculation is quite complicated because it involves many different numbers, but it takes into account all of the different items of the company's balance sheet that allows the company to fund its operations. So this is why it's called the total invested capital. That is the main difference between these numbers. However, on a company to company basis, you might see companies that have a higher ROA than an ROIC, but just keep that in mind. This is why the ROICs generally a more preferred metric because it takes into account all these additional factors that we talked about that the ROA calculation does not. However, the big difference though is that the ROA calculation is a lot simpler to perform, and this is why a lot of people use it. But I'm gonna show you a way right now in which you can calculate the ROIC and the ROA for as many companies as you like, from local, meaning American, and also international stocks. So that way you don't have to worry about all these calculations for every company you analyze, but you can get these numbers for as many companies as you like and be able to compare them side by side. The best way to perform this is to use the Whitesheet screener, although you can go online and look for a different way to get stock list, but this is what I recommend. So you're gonna go on the screener, and let's say that you're looking for companies that have a market cap greater than, in this case, 5 billion. We don't care about the price. For the sectors, we could select energy companies. This is just an example. The exchange, we're not gonna want to look at the exchange. Actively trading, yes. So these are companies that are actually trading in the stock market. And just like that, you're gonna be able to get a stock list like this, for which you can get a whole bunch of metrics. So I'm just gonna get rid of all this stuff. We could keep it if we really wanted it, but this is just to prove a point. So I'm going to remove this. So now we only have the symbol and the company name, and now we're going to be able to add more stuff. But first, I'm going to get rid of these filters right here, go back to the top, zoom in, and now we're going to type the ROIC and the ROA. To get the ROIC and the ROA, which are the two metrics that in this case we're looking for, we're going to be using Whitesheets. And on this page of Whitesheets, you can see what data is available and what function you need to use to access this data. So in this case, we're looking at the WISE functions, we're looking at key metrics, and right here you will see the ROIC. Unfortunately, there is not a direct ROA metric available yet. This is something that may be added into the future. However, there's all the other metrics that make the ROA calculation possible. So that's how we're gonna do it. So to go back to the spreadsheet, we're gonna go ahead and just paste the formatting here. There you go. And now we're going to use the WISE function to access this data. So you're gonna do equals WISE, then in the function right here, you're going to get the different parameters that you need. So first you're gonna need the symbol. So this is the symbol that we're gonna use. And then for the parameter, we're gonna look to get the ROIC. We can lock this in. And then for the period, we could enter a year like 2021, 2022, for example. But in this case, what's better is to use TTM. And TTM takes the trailing 12 months of data. So it allows you to compare the ROIC apples to apples, regardless of whether or not particular companies have different fiscal dates when they release their financial data. Once you have this, then you're going to click enter, and then you can simply drag it across for your different list of companies. And as you can see, what's going to happen is that slowly you will be able to get all of the data that you're looking for. So there you go, just like that. Now we have the data, and now we can go ahead and start to do some more analysis on the ROIC. Next up is how do you get the ROA? The ROA is a little bit more complex, but don't worry, it won't be anything too crazy. So you're going to use the WISE function again, and now we're looking to get here the net income. And then we're going to select TTM, which takes the latest value from the latest quarter in the income statement in this case. And now we're going to divide it by the WISE function again for this same ticker. And we're looking in this case for the total assets of the company, and then we're going to select TTM. So in this case, the total assets, that is the latest quarter of data available. So there you go. This is going to do the calculation. Now we can turn this into a percentage, and then we could drag this down so that way we could get this number for all the different companies that we have right here on our list. As you see now, the data loaded, and now we can go ahead and do some comparisons to see like which companies have a higher ROIC than the ROA, and what are some potential opportunities that you can take advantage of with this information. Moreover, you can continue to add more information right here in terms of key metrics like dividend yield, the actual live stock price of a company, and pretty much all the metrics that you can imagine are available on Whitesheet. So that way you can kind of build your your own custom stock screener and be able to compare a lot of companies in one view so that you can make good investment decisions faster. Now you know the difference between the ROIC and the ROA and how to use these profitability metrics to find good investment decisions. If you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this that's going to allow you to take your investing game to the next level. I'll see you in the next one.